Hey guys, Kylie here, and today I'm going to be looking at whether or not China could trigger a global economic collapse. That includes what might cause such a scenario and what it might look like if it did actually play out. Okay, so China is the second largest economy in the world, or the largest depending on what measure you follow. It's also called the factory of the world because so many of our products and so many of the parts that go into those products are made in China. So it really goes without saying that if the right circumstances were in place, China could certainly create some kind of global financial crisis. Outside of something as drastic as, say, war, a major slowdown or a recession in China would certainly drag the rest of the world with it. And in fact, this very scenario has been a major topic of concern for policymakers and analysts the world over for some years. So just to be clear, China is already certainly slowing. But what makes the overall outcome of this quite unclear is that every country in the world is slowing thanks to COVID-19. By April 2020, China's economy had shrunk 6.8% in the first 3 months of the year, compared with a year ago. It was the first reported reduction since 1976. Just as the country was in the final legs of the Cultural Revolution. It has rebounded so far in 2021, but there are fears a number of headwinds could play a role in a further significant slowdown. These include the US-China trade war, high Chinese debt levels, a property market crash triggered by Evergrande, ongoing energy shortages, on top of COVID-19. The question is, how much of an impact would a Chinese recession have on other countries, and would it be as bad or worse than the GFC? In fact, we may have come pretty close to this very scenario just a few years ago. So I lived in China during a pretty crazy time between 2015 and 2016. In June 2015, China's hyped up stock markets finally burst, with the Shanghai Composite Index falling around 30% in just 3 weeks, dragging global markets along for the ride. Needless to say, it was a pretty exciting time to be reporting on the markets. At the time, there were a lot of signs that China was undergoing an economic slowdown. China's central banks responded by devaluing the yuan against the USD. And while this meant China's export goods could become cheaper and so more attractive, the move shocked global markets and, more importantly, resulted in billions of dollars leaving the country. After all, nobody wants their funds tied to an unstable situation. This exodus of cash meant the banks risked running low on capital, which is exactly what we saw during the GFC. When banks run low on funds, they can't lend to businesses, and the economy grinds to a halt. A lack of cash or liquidity in the markets is one of the key trigger points for a major financial crisis. The other trigger is a high level of bad debt. Arguably, China already ticks that box, which I'll talk more about later. By October, the IMF was having crisis meetings over whether the situation in China would result in another global financial crisis. By now we know the outcome. Thanks to some pretty swift policy maneuvers that halted funds from leaving the country, China survived the crisis and the world would soon forget it ever happened. But it was pretty dicey there for a minute. So could it happen again? In an interview last year, Tom Orlick, Bloomberg's chief economist and author of the novel China, the Bubble That Never Pops, painted a picture of how he thinks it would play out. And he said, it starts with the default for a single borrower. Banks recalculate the risks associated with lending to smaller borrowers. They start pulling back lending, they start refusing to roll over loans, default spread, and what starts as a kind of a single default spreads out to be a systemic crisis. And you have kind of a self-feeding shock similar to what we saw in the United States after the Lehman shock in 2008. In this scenario, China's growth, which let's say after the COVID shock goes back to 4 to 5% a year, craters, and you have a period of contraction in China's economy. If you've been following the news, that picture might be ringing a few alarm bells, because that is exactly what we saw happen with the Chinese property giant Evergrande. And this takes us to the most current likely scenario that could trigger a financial crisis from China. Evergrande is the world's most indebted real estate firm, owing around $300 billion and on the verge of collapse should the Chinese government not bail it out. and the crisis is already showing systemic red flags. A few weeks after Evergrande's default, another property giant, Fantasia, also missed a debt payment of more than $200 million. Fears that it could be another Lehman Brothers moment saw US Secretary of State Antony Blinken deliver a warning that the company's downfall could affect literally the entire world. The reason is that China's growth story is very reliant on the property sector. As of 2016, real estate and construction work accounted for 30% of the country's GDP, depending on which estimates you look at. That's up from just 10% in 2000. In fact, China's property market is now worth around $60 trillion. That's 83 trillion Australian. But while a property collapse in China would be dire, many analysts argue that the downfall of Evergrande is a different scenario to what we saw with the Lehman Brothers. IG market analyst Kylie argues that even if the company does collapse, it would be unlikely to trigger a crisis like the GFC. The main reason is that Evergrande isn't as integrated with global financial markets as Lehman Brothers. In fact, of the $300 billion owed, only $20 billion is owed to offshore lenders, which is still a big number, but unlikely to cause the damage that we saw during the GFC. So the Evergrande collapse wouldn't necessarily trigger an immediate global crisis. You wouldn't exactly see a chain reaction of companies going bust around the world because of it. But unless it was handled really carefully, it would trigger a major slowdown and potentially a deep recession in China. Orlick argues that if China's financial system implodes, then we don't actually see that immediate financial ripple effect. What he does see in the immediate sense is global stock market collapses as investors shift money out of riskier assets. The more important impact would be the economic trickle-down effect around the world. Countries that rely on sending exports, particularly commodities, to China would be among the worst hit. One of the best examples of this is Australia, which exports 70% of its iron ore to China. Iron ore being Australia's largest source of export revenue, worth about $117 billion. And of course, iron ore is the key ingredient used in steel, which is primarily used in Chinese construction. In fact, Rodda argues that in the event of a financial wobble and economic slowdown in China, Australia's economy and equity markets will be among the worst affected, which is scary news for us Aussies. This potential economic slowdown in China would also impact Chinese consumer demand, which would in turn impact countries in the area such as Thailand. For example, if China's manufacturing sector slowed down, that would hit a number of Asian countries tied to the electronics supply chain. If electronics producers go bust, it would have a negative impact on Japan, Korea, and the Philippines. Meanwhile, the demand for other commodities like oil would also significantly drop, which would result in a slowdown among oil exporters. And this would be at crisis level among the smaller oil exporters, such as Venezuela. However, Orlick argues that in the case of a Chinese slowdown or even a recession, not all countries would be as severely hit. The US and Europe, for example, he thinks would see less of an impact. So the Evergrande crisis is certainly one to be concerned about and one that analysts and policymakers are watching very closely. And it probably couldn't have come at a worse time, just as a number of other factors are also influencing China's economy and causing it to stutter. China is currently facing widespread power shortfalls. This is leading more than half of China's provinces to introduce electricity rationing. There are a number of reasons for this, including restricting the use of coal to hit carbon emissions targets, as well as the government price limits on electricity. But the fallout is that it has interrupted supply chains the world over. The real concern here is that we could see the prices of everyday items skyrocketing, which is what inflation looks like without the wage increases. On top of that, major technology and electronic companies, including Apple, all rely on China to some degree to supply parts for their products. Depending on how long these supply chain slowdowns go on for, we could see some electronic companies start to go under. Okay, so this is all looking pretty dire, but there are some reasons we may not need to worry about a catastrophic China global collapse. First of all, one of the big concerns that people have about China is that it is hugely indebted. While China's large debt to GDP ratio is certainly cause for concern, it's mostly government-owned debt loaned to local businesses. China is famous for its very high savings rates, which means that a lot of people in China prefer to store their money in savings accounts in the banks rather than spend it. In other words, they hoard their savings. After the global financial crisis, China implemented a number of policies to boost businesses in China. In general, these policies really did seem to work. The country steamrolled ahead at an incredibly fast pace over the last decade or so. It's just reaching a point now where we're hitting kind of crisis levels of debt. The fact that most of China's debt is state-owned and oftentimes loaned to state-owned enterprises or Chinese government-owned companies makes it much more manageable, especially in China's socialist context. One economist and author, Anatoly Kaletsky, also believes that China's numbers are often exaggerated or taken out of context to make an impending crisis look much more dire. What? That doesn't sound like the media or the title of this YouTube video. He argues that the response by Chinese authorities are often universally criticized, such as the response in 2015 to drop 200 billion into the stock market and devalue the yuan. In this case, leading people to believe that the authorities are desperate and that a collapse is imminent. He said this belief quickly shaped reality as market analysts blurred the distinction between a growth slowdown and economic collapse. However, it's worth noting that China did successfully ride out what could have been a very serious crisis. The government's control over all of its key industries gives it enormous flexibility in handling any crisis. In fact, SOE output accounts for about 50% of output today from China. That's a lot of output that is effectively controlled by the government. On this front, markets, including the equity market, are often influenced by government agendas. While this happens the world over, there's a lot more control than you'd get in, say, the United States, Australia, or the United Kingdom. This control over the markets arguably has its downsides, such as bias towards lending or allocating resources to SOEs over, say, private firms. But by that same token, it also allows it to be flexible in terms of lawmaking and stimulus measures in handling crises. So in conclusion, could China collapse the global economy? As the world's second biggest economy, could it create some kind of global financial crisis? Yes, undoubtedly. I don't think that's in question. But would it want to do so? Probably not. Doing so would probably just hurt China. And if there's one thing I know about China's CCP, it will do anything to maintain long-term growth. So far, it's proven that it has the ability to carry out its plans. That's it from me. Don't forget to like and subscribe. And I'd love to hear from you. Do you think China is going to enter a recession or a slowdown that could have trickle-on effects to the rest of the world? What do you think this might look like?